Okay, we're on to Chapter 5. Chapter 5, we go over the worksheet, the different columns in the worksheet, and we present and or make financial statements from there. So our learning objectives or section objectives: complete a trial balance on a worksheet and prepare adjustments for any unrecorded business transactions. These are called adjusting journal entries. So right here, this is an example of a worksheet. So the worksheet has an account name, has 5 sections, and each section has 2 columns. So the who, what, when is over here. Who, the name of the company. What is the worksheet, and when. Real important. This month ended December 31st. So from all the transactions that happened on December 1st through the 31st, will go on this worksheet. This could be for a quarter. This could be for a whole year. So first, we start with the trial balance. We have debit and credit, and the combination of these, the totals of these 2 columns will match. The totals of these 2 columns will match. These are the adjustments. The adjusted trial balance is just the addition of the adjustments from the trial balance. We're going to add and subtract. Then from the adjusted trial balance, we can make the income statement and we can make the balance sheet. So the steps in the trial balance: enter the name for the general ledger account name. So over here, these are the names over here. Transfer the general ledger account balances to the debit and credit columns of the trial balance. So originally, we prepared journal entries in the general ledger. After we made the journal entries, we posted them into. We used the general journal to post journal entries. After the general journal, we post them to the general ledger. So we total the debit and credit columns to prove that the trial balance is in balance. The combination of the total of the debits to the credits, if they're not equal, then there's either been a transposition of a number or some kind of error with the debits and credits through the journal entries, or even added and subtracting when you added up the ledger accounts. So when we're done totaling up the debits and the credits and they do match, we place a double line underneath each to show that all the work in that column has been complete. There's nothing needed to be added. So let's talk about the account names. We have the assets, then we have liabilities, any capital accounts, drawing accounts, and we have the income statement accounts. So this is all the balance sheet accounts. These are all the income statement accounts. Fees income, also known as revenue. So in this example, we're going to have 4 adjustments, and what we're going to do is we're going to create new accounts to account, for like a better word, for these adjusting entries. So we have depreciation. We have to account for depreciation as time passes. We account for supplies at the end of the month. For those supplies that we've used, we go into debit supplies expense and credit supplies. Same thing with rent. As time elapses, just say we prepay rent. In this example, we prepaid 2 months, $8,000. At the end of 1 month, half of that, or $4,000, will go over to the income statement by debiting rent expense and crediting prepaid rent. We're reducing that. So here's the other side of the entry to depreciation expense. We debit this expense account and we credit accumulated depreciation, which we'll get more in detail as the slides progress. So what we're doing is we're transferring the information from each ledger account to the trial balance. So originally, these are all the journal entries that we put into the ledger. So on November 30th, before the 1st of December, we carried the balance forward at 87,000. December 31st, we had a debit, so we increased cash here, we increased cash here, and decreased cash here. But every single entry we bring over the new balance. So 123, we had 2,000, we have 125, we subtract 8, we paid cash of 8,000 for something, And we don't know that, but we can refer back to it with this on the general journal on page 2. We can find out more information there, and so on. So the end balance here is after the last $5,000 credit is 11,350, and that's the number that we bring over here. So we do that for all of these accounts, and the debits and the credits will total, or should total. That's your checking point. So we see in this example, place a double roll. This is a double roll underneath. So that's your check to say, hey, this is in balance. We don't have to add anymore. So here's all the balance sheet accounts, which in that here on the drawing, then revenue accounts and the expenses are income statement accounts. And it'll always be in that order. So the adjustments. The next column is called the adjustments column. So at the end of every month, we have to account for unrecorded transactions. So far, from what we read in the textbook, we have to account for depreciation, prepaid supplies, prepaid rent, or I should say not prepaid supplies, but just supplies in general. So we're going to account for those here, and we'll see how we account for those. So the company began the month with $1,500 in supplies. At the end of the month, it had 1,000. So you can just assume that the difference, 500, is what was used. So to get that $1,000, we had somebody count up the supplies at the end of the month, and we know we started with 1,500. If we end with 1,000, that means we've used 500. So 1,500 minus 1,000 is basically 500. So this $500, not the end balance, this end balance is going to be in the adjusted trial balance. But in order to get here, we have to show an adjustment, a journal entry, and well, we'll have a subsequent journal entry, but we have to show that how we have to account for that usage. So the key number here is 500. So on the adjustments column, we're going to put letters here like A, B, C, D. So if we have 3, we have A, B, and C. If there's another one, we have D. So we go in order like that. So the debit is going to be to a supplies expense for $500 because we're increasing the expense. That's going to go over to the income statement and reduce net income. Supplies, the asset, we're going to reduce by the same amount. So as of right now, the total of debits equals the total of credits, but we're not done yet. On November 20th, Wells Consulting paid $8,000 for December and January rent. As of December 31st, 1 month later, 1 month's rent has been used up. So how do we account? How do we account for that? What dollar amount of rent was used during the month of December? So in reality, we would take the amount of months and we take the total 8,000 divided by the amount of months. So if it was $12,000 and we had to just say we're doing the whole year, it would be $1,000 a year, $1,000 a month that we would actually adjust. In this example, we're only dealing with 2 months. That's just how the example is. So it would be 8,000 divided by 2, or 4,000, or 8, we know it's half, so we'll subtract half of that. So the amount that was actually used is going to be part of the adjusting entry. So here's that example. We're going to reduce an asset by 4,000 by crediting it in the adjustments column, and the corresponding debit is going to be to rent expense, which is going to go to the income statement and reduce net income. So depreciation. Depreciation, don't confuse this with market value. It's basically just a rational way to allocate cost. So if I buy an asset, also known as long-term asset, also known as PP&E, property, plant, and equipment, it's going to be a tangible asset. And just say I spend $10,000. And you know what, we can go into an example here. So For 3 months, there's going to be expense for 3 months. We're going to be using something called, in this example, straight line. Straight line depreciation is basically you're taking the cost. We're going to allocate the cost. So again, it has nothing to do with market value, and we're going to subtract something called salvage value. Salvage value is basically what what is the residual, or what is the cost of this asset at the end of its life, at the end of its useful life. So this process here is allocating cost is called depreciation. So I had mentioned straight line depreciation. Straight line depreciation allocates an asset's cost in equal amounts, and that's key right here. It's always going to be the same number because we're dividing it by the total amount, total periods that it's going to reflect or benefit from the asset's use. So a straight line allocates an asset's cost in equal amounts each counting period of its useful life. So here's the actual calculation. Straight line depreciation equals cost minus salvage divided by estimated months of useful life. In this example, we're going to use months. There's some examples in prior classes I had where we did it by years. So if you do it by 5 years, you can divide it by 5, then divide that by 12, or just get the monthly in the beginning. So we purchased equipment November 2016, and remember, we're doing this for the end of the year, which is 12/31. So the cost is 11,000. So the useful life is 5 years. So we have to calculate that into months. So it's 5 times 12 because each year has 5 months. Salvage value is 0. So what is the dollar amount of depreciation expense for every month? Because we're going to have the same payments I shouldn't say payments, same cost allocation every month. So 11,000 minus the salvage, which is 0, divided by 60, and this should come out to 183. So every month we're going to have an adjusting entry of 183. Now if we did financial statements every quarter, which is 3 months, it would be 183 times 3. If we did it every half year, it would be 183 times 6. So adjusting for depreciation, this is going to be the basis for your adjusting entry. So instead of decreasing the asset account, which is called equipment, directly, we have something called a contra asset. So the adjustment for depreciation is recorded in a contra account named accumulated depreciation equipment. So what this account is, and each piece of equipment will have its own accumulated depreciation account. So basically what this is it'll tell you the actual book value, not market value, but book value left on the financial statements. So we have the equipment account. Again, these are T accounts. We increase it, so we debit the equipment account. Actually, this is the normal balance. So the equipment has a normal balance of a debit. A contra, opposite of equipment, is accumulated depreciation. Contra asset account has a normal credit balance. So we can see here, so when we adjust for depreciation, it's going to be, let's see, C. So let's look at the debit first, because I want everybody to start looking at the first thing we do are debits. So depreciation expense, equipment, 183. This is going to go to the income statement, reduce net income. Accumulated depreciation. Again, we're not going to go to the equipment account to reduce it. We're going to use the contra asset account. So when all adjustments, in this example there's only 3, are done, the bottom should total. So 4683, 4683. That's good. We are in balance. So let's go back to the depreciation. Equipment had a debit balance of 11,000. Accumulated depreciation 183. So the original cost 11,000 minus the depreciation taken on the equipment to date is going to be your book value, or stated otherwise, book value equals the original cost 11,000 minus accumulated depreciation. So in our next period, just say the next month, we're going to have another adjusting entry over here for 183. So it's going to be the 183 times 2. We're going to subtract that from the 11,000 to get our book value. But in this example, just 1 month, it's going to give you 10,817. So when we make our financial statements, that is going to be the actual book value recorded, and it depends on how it's recorded. From what I see, some folks may put equipment net, that means equipment net of depreciation, and have that one number, or they'll have both of these. They'll show the original cost and the accumulated depreciation, which I think this is right here is more GAAP approved than showing the net number. So section 2, financial statements, going to complete the worksheet and prepare financial statements and journalize and post the adjusting entries. So here we are in the accounting cycle, chapter 5. We are preparing a worksheet. So the first two sections were the trial balance, the adjustments. Each one of those has its own column with a debit and a credit column each. So now the fourth step of the worksheet is preparing a worksheet is the fourth step of the accounting cycle. So now we have the adjustments, or adjustment trial balance at the adjustment. So first you have the trial balance, adjustments, then you adjust the trial balance, and from here, these numbers, we can make the income statement and balance sheet. Again, this worksheet is not actually a financial statement. It's a tool for the accountant to prepare those financial statements, and especially if you have a lot of accounts, a big chart of accounts, a lot of adjustments. This is not a lot. A worksheet actually helps make that process a lot simpler. So first thing we do is we drag over every account that does not have an adjustment. So for example, the cash, bring that over, the accounts receivable, the equipment, because remember we didn't reduce that, we added an account called accumulated depreciation. My mouse is going bonkers here. Accounts payable, capital, bring over drawing. Again, these accounts were not affected by any adjustments. That's the first thing that you do. Next thing, let's look at the supplies. So what we did is we had 1,500, we used 500. See how one's a debit, one's a credit? If one's a debit and one's a credit, vice versa, you're going to subtract. If they're the same, you'll add. So 1,500 minus 5 is 1,000. That is the new balance of supplies. So over here for prepaid rent, we had 8,000 minus 4. One's a debit, one's a credit, and we're reducing that, so there's 4 left. See, there's no prior balance, so we just carry the 183 over. And down here, so we had remember we had to add these, our little ones down here are the ones that we added. So supplies expense went with the supplies, and we just carry these over. That will total as well. So all these 3 will total, and just be cognizant of these two. They will not total, but the difference will either be the net income and the net loss, which we'll put over here, and eventually the bottom will total. But originally, they will not total. So let's go on to the income statement. The first thing we do is the income statement, and we're going to bring over these accounts. So basically, it's going to be 47,000 minus the combination of these 1, 2, 3, 4, 5. So, and we'll do the same thing with the balance sheet. We'll bring them over, all the balance sheet accounts. So a lot of errors that I find here is just students writing in the wrong numbers. I mean, if you're in a spreadsheet and you can just click plus and click on this, it'll bring it over automatically. So the debit is 13,333, the credit is 47,000. Why is that different? Well, the difference here is see the credit are revenue accounts, debits are expenses. The difference is your net income. So the balance sheet is going to be off. The debits, the credits won't match. Debits and credits won't match. This difference is going to be the net income, because what we're going to do over here on the bottom is we're going to add that net income basically to the prior owner's equity, and that's going to reconcile. Okay, so subtract the small amount from the larger amount. We discussed this is basically you're taking the difference between your expenses and your revenue, and what we're going to do is add that to 13.3, and that should tally up. See, now they match. So what you're going to do if you have a net income, you add that to the debit of the income statement and the credit of the balance sheet, then those should match. If you have a net loss, it'll be these two columns here. Net income is going to be the far columns. So where we are in the accounting cycle, we're going to prepare the financial statements, step 5. And we're just grabbing these numbers from the income statement column, and we're just going to make it look pretty with the who, what, when, or who, what, where. I always get confused over that. Said better, the name of the company, the name of the financial statement, and the period of time. And that's the big difference between this and a balance sheet. A balance sheet is a point in time. This is a period in time. So we have the revenue minus the expenses equals your net income for the month. For the most part, I just see this as net income. The author of the textbook wanted to say for the month, but we know it's the month because it says month ended over here. Either way is fine. So this is the first financial statement that we make. The net income then goes to the statement of owner's equity. So here's the prior balance. We add the net income here. Let's not forget about our withdrawals. So we subtract those two, and it's an increase in capital. So the 28,667 plus the 100,000 equals your 128,667. So we now have the capital, and we can now make the balance sheet. Balance sheet, you can do different formats. You can do this format, or you can just I forgot what the book calls it, but it's just all down here. You have total assets, then you have liabilities and equity down here. Either way is fine. So here's where the capital figure is plugged in. Here's a report form. So what does this say? Is the account form and report form same figures, just reported differently. In practice, what I see at the bank is mostly I'll have the report form. So your total assets will always equal your total liabilities and owner's equity. So again, like I said before, the worksheet, it's not going to be a financial statement. It's more of a permanent part of the accounting records. That's a good way of saying it. It's not a permanent part of the accounting records, I'm sorry, and it's not a financial statement. It's a tool. So a permanent part of the accounting records are general ledger, general journal, financial statements, not the worksheet, but the worksheet's important. Gotta love this slide. So where are we now? We have to record the adjusting entries. So what adjustments did we have for Wells Consulting? We had 3, right? So we had adjust for supplies, expired rent, and depreciation. So this is what we're going to do in the general journal. We're going to do the journal entries, then we're going to post them. So journal entries are no different other than adjusting entries. Some folks, some companies make a whole new page. I probably recommend that in your general journal called adjusting entries, and put all your adjusting entries. Debits will equal credits. Supplies expense, that's an income statement account and a balance sheet account. All adjusting entries will always have an income statement account and a balance sheet account. See how that is for all these? Income statement, balance sheet, depreciation expense, income statement, accumulated depreciation, although not an asset, it's a contra asset, goes on the balance sheet. So it just gives us one general ledger account for the actual posting to the excuse me, to the ledger. So supplies expense, and we right down here we put adjusting. This came from journal page 3. That's our audit trail. So when we post it, we put it here. It's in the ledger. We get the account number. The account number will already be in there from the chart of accounts. So what we're doing, and this will show you, bring the date down, adjusting entries, make sure it says adjusting. Again, I'm going from the journal to the ledger. Page 3, 500, and bring the balance over. And again, this is just for the supplies expense. You do this for supplies, you do it for the rent expense, all the way down for every single account used. So it could be a laborious task, but typically now companies are doing this computerized accounting, so it's basically done for you, but at least you know why it's being done, and how for that part. 517, we're post reference, so as soon as we put it to the ledger, we put in the 517 there, and we'll know we posted that. So that concludes chapter 5, and certainly let me know if you all have any questions, and